Hello, everyone. Welcome to the American Dreamers Club webinar series. This is our monthly webinar series geared to helping individuals learn all about when it comes to your finances, wealth, and education, right? It's all about inspiring and making sure that you have the tools necessary to better your financial journey. All right, so let's get started. So today we're going to talk about the Family Bank Basics, and basically it's basically called the Financial Club webinar, right? So with the Family Bank, like what does the Family Bank mean, right? And what exactly, we're going to go through the myths, the tricks, and exactly what does it mean when it comes to the Family Bank, the advantages, the disadvantages. We're going to talk about all that tonight. So with the family bank infinite banking concept, right? It is basically infinite banking is a long-term financial strategy that involves overfunding your permanent life insurance policy so you can use it as a line of credit, right? So you can use your permanent policy again for an infinite banking strategy, which is a dividend paying part of the option in the policy itself. And we're going to go a little bit, I'm going to explain exactly what the difference between the family bank and an infinite banking concept, because a lot of times people kind of call it the same things, but they're actually different things, right? So let's break down the myths and tricks when it comes to your traditional bank, right? And how that works. And then also the policies and how that works. We're going to cross compare both of those, right? So when we're talking about the traditional bank, you usually are going to earn anywhere from a 0.58%, whereas on the cash value part of the policy, you're going to be doing anywhere from 2 to 7%, right? Tax free when it comes to the growth and the cash value of that policy, right? When you're talking about the withdrawals and the earnings, right? Certain money can be again available to withdraw, but you also get to have the full amount of your cash value that's available for your withdrawals or loans. Now, when it comes to your traditional savings account, they normally cannot take a kind of loan on your savings, right? Unless it's kind of obtained through a specific type of bank. But on these types of policies, you can be able to take a loan plus borrow enough, right? And also it can count to generate interest and dividends while it's still in the policy, which is so amazing. Another part is the loan repayment, right? So you don't have a specific due date. You are just required again when it comes to your loan amount. You can pay it back as you choose. So if you pay it back, great, it grows. If you don't, well, it doesn't grow, right? And also the paid on death beneficiaries, right? So we have the paid to death. So if something happens to you, that person just gets your savings. Whereas on the cash value for the policy, you get the death benefit that's tied to it, plus the money that's in there. So that's a big, big difference and an amazing plus. And of course, with a traditional bank account, there's no living benefits, right? Whereas with the policy, you're going to get your chronic, your critical and terminal illness that'll allow you an opportunity to grow your money when it comes to that. And at the same time, if something happens to you, you get terminally ill, chronically ill, you can tap into those funds to be able to take care and not have to pull that money from your savings account. Right. And then, of course, there's a cost. The cost, of course, you can have your money in the savings, there's no premium. But when you have a policy, you have the premium to pay because that money is going to keep allowing the cash value for that to grow. So there's some benefits of the family bank strategy, right? Which is the family bank infinite banking concept, which is of course easier for you to get a loan, tax advantages, and the asset protection part of it. And we'll go into a little bit, and a part of those couple concepts. But I wanted to at least break down what that family bank, strategy kind of looks like. And this is a great diagram that shows it. So if you have a family bank and your like your board and your trustees and everything from that, you have your specific things that people from your family can only get money from this, whether it's from the ownership, your education, health, right? You literally then purchase policies that goes into the family bank, right? And then you have your beneficiaries then could then borrow from the family bank, right? And then you take policies on those people and that goes back to the family bank. And then once that beneficiary dies or any individual or family member dies, that money replenishes back the family bank, right? So they can have their own policies, but there's a separate policies that have to be taken on the family bank and then those costs, right? So that's pretty much how the strategy works. But it does involve cost setting up a trust, then it involves all the policies. So it's a much bigger cost. Not saying it's not possible, it's very possible. However, there's much more fees involved, right? So that's the family bank strategy. Whereas the infinite banking strategy, we're going to show and dive into that a little bit more, right? So when it comes to the family banking also strategy, right, which is the infinite banking part strategy, when it comes to the policy part, we're just going to talk about a little bit, some of the breakdowns with that, right? So people could kind of understand like, okay, it's a non-correlated asset. So what does that mean? It's not correlated to the stock or the housing market. It has nothing to do with that, right? But you're still putting money into there. Okay. So that's what non-correlated means, right? So it's also important to not have assets that are tied to the stock market, but it's still what you call an asset because it is cash value going within the policy. It also can help improve your cash flow and liquidity. So basically, if you need to, for example, if you had to go and get, a real estate property and take out a loan from that or sell the property, or you literally have to cash out for the HELOC or the cash out refi. Here you can cash out and refi your own policy, and that makes it so much better, right? Then we have what we call the personal family financing, right? So when it comes to that, what does that mean? That means you are in control. You are the owner of the policy, right? You become the financer for your policy. So you get to loan money out of your company. The company can charge quote unquote interest, right? You then can pay back the use of the money, right? Then you can write off your interest on your taxes, right? Recoup that interest, then pay back that policy loan, and then repeat the process infinity, infinity, infinity. That's what's called the infinite banking strategy, right? So just understand when it comes to those parts. Your equity storehouse is this, right? It's basically uninterrupted compound interest. It's just compounding, 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 as long as there's cash and money in there to start with. You want to start with as much cash as you can so that you can actually have that growth. Then you want to be able to leverage, right? So when we're talking about a leverage, let's say, you want to be able to grow it tax free, right? Of course, the earlier years it's going to take a little bit longer, but over time, it's definitely going to grow a bigger bucket. And I'll show and I'll demonstrate in one of the examples for you. The 401ks or the IRAs. So if you choose to fund a 401k IRA, that's great, but also understand that there is no death benefit for those, right? And if you're comfortable with losing at least 30% when those taxes come out, then go that route, right? But if you're like, hey, I want to be able to put my money in somewhere, let it grow, borrow against it in the next 30 days, this is the strategy for you. The difference with the IULs, if you went on our IUL webinar, for those who did, you may want to catch that, click back to IUL webinar. But if you didn't, you don't understand the difference with the IUL and infinite banking. Two different concepts. IUL is also tied to the index and it's going to grow over time, but there will be some ups and downs, and you can't really borrow from it just as fast, right? You just got to allow that growth to happen if it happens because it's tied to the index. Okay. So just remember that when we're talking about tax deferred growth, we spoke a little bit about that, and the tax-free access to your cash value. So you have anywhere from 3% to 7% of your tax value access, right? So understanding that, and you get the guarantees, right? So you're guaranteed your cash value, you're guaranteed your death benefit, and you're guaranteed your fixed premiums, and you're guaranteed your compounding interest growth, right? Also on the private side, right? So for example, someone runs your credit report. This money's not going to show up on there, right? If you late or you didn't pay or whatever, or you did pay, you have a lot of money in there, whatever the case may be, or a title search when you're buying a home, right? This is also not going to come up, but it's still an asset, right? Because it's your money. Your money is your asset, right? That's part of your cash. So you want to make sure that you also have that. Also on the creditor protection, of course, most states, I think the only states is like California, Colorado, and Massachusetts, and maybe like one other state that they limit the amount of cash you can have in there without having to like be a part of your whole credit thing in case someone sues you and all that. So just keep note of that and always check the state. But New York, New Jersey, we're good. We can just keep rolling, right? Yes. So what is the whole concept? Become your own bank means you loan out money to your own company, charge your company interest, your company pays the use of your money, you write off the interest, you recoup that interest, and then you use that to pay back the policy loan, and you repeat that process infinity, 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 infinity. Okay, that's how it works. But you got to use it, pay it back, use it, pay it back, use it, pay it back, and let it grow. And this is great for flippers, great for people in real estate, great for people also want to be able to, use this for college, for their sending their children, purchasing a home later in life. You can use the strategy for whatever that you want to do. This is your family bank. And again, it's your family banking strategies. It's all about how you want to be able to use that for yourself. Okay. All right. So I did say some of the positives, some of the advantages, and they are some of the disadvantages of the infinite banking strategy. Again, you got to qualify, so it will require some tests, so maybe some medical, some blood work for that. And there's also the cost of funding. So you're going to need initial lump sum, right, to let it grow initially. And of course, your premiums, which are your monthly premiums. And of course, online, there's always a lot of misconceptions and, misinformation about the whole infinite banking concept, right? That's why I'm here. My name is Nakai Lewis, agent, founder of American Dreamers. And my goal is to make sure to debunk all this misinformation and all that so that you can know exactly what it looks like, exactly how to do it, right? And then, you can make your decision from there, and hopefully you decide to work with me as your agent and allow me to help you. All right, and continue your infinite banking concept, right? So how does it really work, right? We're going to do what we call overfunding, which is the paid up additions rider. So we're going to allow you to overfund the policy, right? Because you need to understand what you're doing with this, right? You're putting your hard-earned money, and I want you to be very specific and understanding where it's going, how it's going, right? So there's usually what we call dividends that are going to get paid. And when I show you the sample illustration, you'll see what we call the dividends that are getting paid, right? So this will allow you to overfund your policy right up to what we call before it becomes a MET, which is like a taxable occurrence, right? So you could fund it all the way up to there, right up to that line, and then allow that to grow your cash value, right? And of course, furthermore, when it comes to your interest and dividend payments, you'll be able to let that grow as well and then use up your paid up additions, which is your PUAR, your paid up additions, right? So you want to be able to maximize over time the cash value when it comes to your policy. Okay, so when you're designing these policies, you want to make sure that, of course, you choose the right agent that knows how to do it, because if not, you're going to get yourself into something. But make sure you have a prepared agent understands the value of the paid up additions, and it's structured in the right way so that, the traditional life policy, it's not just that way, but it's also designed just a little bit differently. So they'll give you the faster access and fast cash, right? So we're going to have a live demo, right? I'm going to go over the live demo a little bit about what we're doing when it comes to this. Okay, so we have basically, I'm putting in $10,000. I'm going to pay $250 a month, right? And literally, right, over for that year, I'm going to start off with the benefit of about 398,000, and I'll have about a cash value about 11,390 approximately, right? Which I'm going to again take a loan from it, right? You don't want to surrender the whole thing, because then that closes out the policy. You want to pay your premiums on time. You want to show the insurance company that you're trying to keep this banking strategy up, right? Quote unquote banking strategy, right? But this is your insurance policy, right? So the way that you do this, let's say you're going to put in your 13,000, that's included 3,000, that's the 250 for that year, plus the 10,000, that'll bring you up to $40,000, right? $40,000 will net you about 42,000, right? And then over the next 20 years, I'm going to put in 68,000 of my own money. And then I'm going to have about 94,000 in my total cash value. That's going to allow that to go ahead and build, right? So as you can see, something happens to me, my beneficiaries will get this, but I have this access now today. Okay. And then moving on, let's say up to age 65, I'm going to put 96,000 of my own money. As you can see, I'm going to have about $171,000. Now you can use that to borrow from yourself. You want to be able to take loans, you want to take a yearly salary, whatever that you want to do, the possibilities are endless, right? But you have that access for it to grow tax-free in the policy. That's the most amazing thing, right? As long as you take a loan and you don't withdraw it all, that's the way it works, okay? And for your beneficiaries, if you don't pay back that loan, it's basically going to deduct it from their money and their benefit amount. So just keep that in mind. Okay, over 40 years, I put 124,000. I'll have about 279,000. Over 50 years, I have 144,000. I put 406,000. And over here, as you can see, all the way up to life of the policy, we're living up to 120, guys. So just, you're going to see everything 120. Just think about it. If I live to 120, am I going to have enough money? You need to think this way. So if you're in your 20s, you're in your 30s, you're in your 40s, you need to start thinking about, okay, where and how am I going to stretch my funds? I'm self-employed. I'm a business owner. I'm a real estate agent. I'm an investor. You need to set up separate buckets of money that's going to diversify your whole portfolio. Okay, so I'm putting $162,000, and basically my total cash value for this, let's say at age 70 years, which is about 105, will be about 634,000. As you can see very well, you have an opportunity here to grow 115 up to 751, right? And it just keeps going. It just keeps going because we're going to just keep living, right? And of course, your beneficiaries will have access to that amount. Amazing, right? Yeah, I know. I think so. All right. And here's another example. If you're like, you know what, Nakai, this sounds great. I don't have $10,000, but I do have $250, or I have $300, or $400, or $500, or $600 at least. We can still set it up for you. You don't have to have the lump sum, right? I want you to get started, start building something for yourself, right? So you're going to be able to put in $3,000, right, per year, 3,000. As you see, I put 30,000 over the next 10 years. Then I can access about 30,000 in cash value. Over here to be 20, that's about 58,000. That's about 78,000 approximately in cash value. And in considering moving, let's say 65, right? Remember, we had the 65 age mark. So I did about $87,000 here, and the cash value about 148, right? So if I need to borrow from this for whatever reason during any of this time, you can do so. That's the power of the infinite banking strategy. You're borrowing from yourself. The family bank strategy, you're borrowing from the family bank that has all the members in it. Two different things, two different concepts, two different things. All right, perfect. So now we're continuing, right? We're age 75, right? And we put 116, we got about 248, and continuing on, right? I put in about 145,000 over my life. That's it. Okay. Over my lifetime. And I'll have about 641 approximately. Again, it could be a little bit more, but this is on average what you will see at this age, right? This is for a male, age 35 approximately, right? Which is amazing, right? So it's a great way to provide value for your family, provide value for yourself, continue to build, and of course, just having the cash asset available where you can borrow from yourself. So how do you get started, right? On this infinite banking concept, right? You get your cash value policy, whole life policy, you have the specific riders, you fund it. Then of course you can borrow from yourself and then pay yourself back and repeat. That simple. That's the infinite banking strategy. Okay. So I'm thankful and thank you guys for joining us, right, on AmericanDreamers.club. You can go and visit our website, create your free account, right? From there, it'll allow you to get into our WhatsApp groups. And once you become a member, right, this will allow you information and more webinars, in-person events. We're doing lots of things when it comes to the Financial Club. So we want you to be part of the Financial Club Plus, right? That's 100 family members that are going to be getting their trust done this year. We have access to that. I want to make sure that you are a part of it. It's limited to the first 100, right? We want you to get that. So join the Financial Club Plus, get access to that. The pricing is all on the website. And of course, if you don't want to be a part of that club, we have the Financial Club by itself that at least gets you, in the mix, and also, just being able to be a part of the whole collaboration, right? Finance, your money, your dreams, your wealth. You need to have a team collaboration. We do everything from business credit to funding to credit to insurance products, right? Which I'm a licensed agent. My name is Nakai Lewis, president and founder at American Dreamers Club. And I'm so excited that you guys had a chance to hop on this webinar and really learn about everything dealing with the Financial Club, everything dealing with the infinite banking and the financing, right? Because at the end of the day, you want to set yourself up, set your family up, understand exactly how this works, and get it done, right? Action is the reaction. And hopefully that's what you do. Follow us on YouTube at American Dreamers Club. You can also visit us on Instagram at American Dreamers Club. And you can follow me also on Instagram if you like at ASKNEKEI. My name is Nakai Lewis, president and founder at American Dreamers. And thank you so much for joining and watching our webinar.